Hello, this is our second video for Introduction to Accounting. Today we're going to cover some specific topics and then do a little bit of work in Excel. The first thing we're going to do is look at the difference between financial accounting and managerial accounting. You say, oh no, I didn't know financial accounting. Now you're going to add another one? Yes, it turns out that most major companies anyway have distinctly different types of reports. Some that they allow outsiders to look at and others that they reserve for insiders who are managers trying to make decisions, usually with very sensitive and proprietary information. So we're going to look at the differences. Then we're going to touch on a couple of topics that are in the accounting finance area. The first is cost volume profit relationships, CVP, and it's also usually called break-even analysis. Even though that's just one scenario that's covered by CVP, we tend to just call everything in there break-even. Anyway, next we will also look at the time value of money and show you how we quantify the time value of money. And finally, we'll do a little bit of work on Excel throughout the video, but also give you some resources on how you could push your knowledge further as you go into your master's program. On the topic of financial versus managerial accounting, do we have two sets of books? Technically, no. We have one set of books, but that set of books is very comprehensive to be able to do both. Managerial accounting, where we give information all the way down to the lowest level of manager, and the financial reporting that goes all the way out to the SEC and the board of directors. Those could be structured correctly inside of a database system, which is what an accounting system is, so that we could extract reporting based on whatever purpose we want. So the purpose for financial is for both internal and external, but the formality of it and the rules by which they are put together are governed by GAAP and the SEC. So the primary audience, or the most rigorous audience, would be external. Compare that to managerial, where you could be a sales manager or a marketing manager or a production manager or an HR, and you have information you need to do your job in your department. That is what managerial accounting is to help all the different users who have very different needs for information with the information they need to do their business properly. Next is let's look at the level of detail. As you can probably guess from the description, there's a high level of aggregation for the financial reporting that goes outside. You may have one number called revenues, which won't tell you a lot. It just gives you one big number. So it's aggregated for that purpose because we don't want to disclose too much to the outside world and potentially our competitors. On managerial, it's the opposite. If you're in charge of, say, computer accessories for Dell, you don't really care much about the sales of their laptops or their desktops or their monitors. You're in charge of the accessories like the keyboards and the mice, right? So your reporting needs to be on what you control, which are accessories. Users for financial accounting is all kinds of users because anyone can get it. Of course, inside people can see it and they like to look at aggregate data too, but usually the main users are outside of the company. Then we look at managerial, is the opposite. It's everyone who has budgetary responsibility will want to know and have information on which to do their decision. It could be on things like pricing or strategy or production in the factory, and that's information they need that's very specific to their role. Next is timing. For financial accounting, you'd be lucky to get a financial report within 2 months of the year end. However, that's not acceptable whatsoever for internal reporting. We normally count in days. Usually it's 5 to 10 business days after the end of the month. All the managers should get their monthly reports. So the frequency and the pace is quite different for managerial accounting. And as far as evaluation, what is the perspective? Well, for financial reporting, we're looking at the past, looking at what just happened, actual decisions and results. For managerial, we look at the past, but we're also using it to somehow get insights into the future because we're looking to make plans, do analysis and planning for new initiatives or new projects. So that's why the timing is slightly different because the perspective of the user is different. And then accounting standards. We already talked about GAAP and generally accepted accounting principles as put out by the FASB and as supported by the SEC. Those are the rules for external reporting. But internally, we are really trying to get at reality, truth and justice, if you will. And so whatever information is in a form that we need to really understand our business and what's driving it is the information we want. There are some specializations for management accounting, just like a CPA is a certified public accountant. There is a CMA designation, certified management accountant. It's not nearly as well known as the CPA, of course, but there is a focused discipline on all these quite detailed methodologies for doing superior internal information. And then the other aspect is measurement. As we talked about in financial accounting, monetary principle, we're doing everything in dollars and usually not much else. Whereas in managerial accounting, we're looking at overall performance, which includes financial but also non-financial information. If you're in charge of, say, IT, something like what is the uptime or systems availability is probably more important than cash flow, because the whole company and perhaps your whole web business is dependent upon high-performing infrastructure. So that's not a financial piece of data. It's a percentage. What percent of time are our systems up and running efficiently and at a high level of performance? That's what IT manager wants to know, non-financial. So the managerial accounting includes both financial and non-financial measures.